Okay. We're going to get started. Looks like everyone's busy enjoying the sunshine. Okay, so today we are going to talk about my favorite topic, supply and demand. And supply and demand can sometimes appear to be a little bit complicated and difficult to understand, but it really isn't. And so today I want to present a pretty simple method that you can employ to engage in the markets based on a model that is bound in supply and demand. And so, I mean, what is supply and demand ultimately? Supply and demand is simply the difference between the buying and the selling. And if you look on a price chart, you can see, for example, you have maybe a price of an instrument like this moving higher. This is the euro British pound, which is wriggling higher. And then you ask yourself, well, why is it moving higher? But if you look at the strengths of these two currencies, you can see that we have the euro, which is up here, and we have the pound, which is down here. So we have demand for the euro, and we have supply of the British pound. And this is, of course, seen very clearly in a price chart like this, where you have the euro being bought and the pound being sold off, thus causing the euro pound chart to crawl higher. Likewise, when we have a pair chart like this moving sideways, and you ask yourself the question, why is it not trending either higher or lower? And this is simply because that you have something like this, where you have the relative strength between the Australian dollar and the American dollar is the same. And so, of course, this pair is going to move sideways like so. Then you have price when it's moving lower like so. And you think, well, why is it going down? Well, here we have the Canadian dollar and the Swiss franc, which is the CAD franc cross. And you have a very weak CAD and a very strong Swiss franc like so. So, of course, we have demand for the franc, the counter currency, and we have a supply of the CAD, which is the base currency, which causes this pair to move lower like so. And so, I mean, how do you spot this stuff on the price chart? Well, identifying these nice price-sensitive areas is pretty simple, but there are a few rules that you have to pay attention to when you're qualifying these areas. So ideally, the best method is to do something pretty similar to this, where initially we'd identify a trend is price on the macro level moving higher or is it moving lower. Then you want to find the origin of the current leg of a move. So if we consider the origin of a move, if you look at this one here, you can see that the origin of this move is the low here, this low just here. So this leg is this leg here has its origin in the most recent major or macro swing low as we have here. So this is kind of the base. This is the origin of this move here. And the reason this is important is because price turned around from here because we had a great demand for this currency pair at roughly this level. And so knowing this, you know that on the longer term trend, the macro trend, this pair is moving higher. And so you want to position yourself long. And this is where supply and demand comes in. Okay, so if we have a look here, we have to perform, of course, an analysis on price, and you have to assess whether or not price has been to a given area or not. And this I refer to as a parent and the child. And a lot of people kind of misunderstand this and overcomplicate it, but it's a pretty simple concept. The only reason I use the terms parent and child is to illustrate that there is indeed a relationship between the two. And once you've identified your area, you draw your rectangle, and then you do the quality checklist, which enables you to kind of backtrack and find the real area of supply and demand. So we're just going to apply this method very quickly. And we can take this, for example, let's go on a smaller time frame. We have Viona in the room. Viona, are you a longer term or a shorter term trader? We have Adam here as well, and Albert. Just type in the chat there if we have long or short term, because this is what we're going to have a look at now. Most people kind of gravitate towards the shorter term trading. We'll just grab a short term example, and for this we'll look at this, and you can see here very clearly we have a downtrend. So you can see that, I mean, this move, it started here and it went all the way down to here. So this is the origin for this this move lower, just up here. And so we know in the longer trend, we want to be looking for somewhere to sell. And of course, keep in mind this is an hourly chart. This is not a major time frame, so you have to be aware of what's going on the greater time frame. For doing this, I like to go up to the larger time frames, and typically I'm looking at the monthly and the weekly and the daily and the 4 hour. But for this example, we'll just go up to the 4 hour and we'll see what's going on. And so you can see that on the hourly chart, we thought that we should be selling, but if you go to the 4 hour chart, we can actually see that we are just in a corrective move on a potential move higher, like so. And so knowing this really kind of puts you in the know as to number one, how you should be entering, and number two, how you should be managing the trade. Because if the 4 hour chart was going down just like the hourly chart, well, then you could perhaps be a little bit more relaxed regarding trade management. But when you have the macro trend against your position, which would be short here on the hourly chart, well, then you want to perhaps be a little bit more aggressive in your trade management. So if we have a look at this, you can see that in the software that I've written here is helping me identify these areas of supply and demand, as you can see. And just to explain it very quickly, you can see here we have an area of demand here. We have a box with a solid border. We have another box here, and this box has dots on it. What does that mean? Well, that means that price has tested it once before, which tells us that this area has already been, the liquidity in this area of demand has partially been consumed, and so the likelihood of this area holding it in the future is less probable. And so the first test is always the best, which is why I like to mark off these areas with the software with dotted lines telling us that the box is a little bit weakened in relation to the first one. This one, the bleeding edge of price, means the price, we have a potential area that's being formed here, but it's not yet confirmed, and so it's dotted. And once it's drawn as a solid box like so, well, then we know that it's qualified, and then we can consider to trade it. But you can see here, I mean, we have the high here, we have the low, we want to be selling. Well, where do you sell? Where do you need to sell? And so this is where a nice clear method comes into play. And ideally, you want to find clear imbalances in supply and demand. And a clear imbalance in supply and demand is going to be visible on a chart as a sudden move, either higher for demand or lower for supply. And you can see we have one here. See how supply kind of drifted down slowly, and then price gapped down very nicely. And we tested the edge of this area here. As a matter of fact, I'm just going to change the setting here. So price went lower from here, and then it's gone down like so. And you can see here that price came back to this area. You can see that price is currently on the edge of this area here, and it tested it once, which tells us that the next time price comes back to the area, we want to be a little bit more careful. Price came back on the second approach, and as expected, it moved deeper into this area of supply. And so we don't want to take this one the next time. We want to take a different area that is fresh and untested. If we look above, you can see that we have this area here that's been marked off. And so when you find an area, you find an area where price releases quickly. I mean, we can't trade all of these, and there's very good reasons for that. Well, number one, we want to ensure that these areas of supply, in this case supply, are formed in a certain way. And if we have a look at some of the criteria that we have here, and we have this quality checklist. And I like to use this, and a lot of this functionality is programmed into the software. But initially, we want to see how price left the area of accumulation. And accumulation is simply the filling of orders prior to a move, either higher or lower. And so price accumulated here for a very short period of time, and then it moved lower. And so you can see that price kind of traded through this area from above. We accumulated, and now price left away here. And so price left the area pretty forcefully, as you can see, which is a good sign. Did price consume opposing supply or demand or cause market structure to fail? Well, I refer a lot to this market structure, and market structure is simply channels or trend lines that have been broken. Because when you look at a price chart, you want to be able to make sense of it. And typically, analysts will make sense of a price chart by drawing trend lines. And for price to move through a macro trend line or important trend line, well, there's going to have to be an awful lot of buying or selling in order for that to happen. But if we mark off the low here, we'll mark off this, and then we're going to scroll back a little bit. And we're going to see what this was able to accomplish. And you can see that we had price left this area here, and it moved up from here. And this area here, which is not a terribly interesting area to trade, because price has been trading in and around the area for a long time, price to the right managed to move through this. So we consumed all of these micro areas of demand, and you can see the consumed areas of supply and demand, and these are marked off with little X's. These are hourly areas of supply to the upside and demand on the downside. And of course, price managed to move through those. The origin of the move was up here. And so the first test worked out fine. The second test we're still working on at the moment. I mean, you can see that price is wriggling up and looking for a place that it could react in order to continue its move lower. So if we look a little bit higher, I mean, this is not interesting to us, because if we look at let me close this. If we look at some of these other quality checklists, I mean, you can see here, I mean, how long did price accumulate? If we go back here, you can see that price accumulated for a long time. I mean, there's nothing but accumulation in and around this area, which shows us there's not an imbalance in supply and demand. There's the opposite. There's a balance in supply and demand. How far did price go? Which I call M, which stands for move, when it left the accumulation. When price left here, it went really far. If we consider this area, this is 15 pips. And when price left, it moved down about 100 pips. So the risk-reward multiplier for this area was very good indeed, which would have qualified this area for a short on the first test here. But now this one's gone. Of course, we have to look higher. So we have to look up here, and you can see we have this area here. Price didn't leave very strongly. It managed to move down and move up. Not good. This one, price managed to move down, but accumulated really close to where the bottom of this area is, and then it managed to move up, which I don't like. Here we have a lot of trading in the area, and this area just up here has been tested once before, which I don't like. We have this area, which is, we had a nice move lower. It's still untested, but I don't like the extended period of accumulation here. And if you look up, I mean, there's nothing really here until we get up to the high just here, as you can see here. And so what I like to do is I like to mark off the high, like so, and then find out if this is a child or a parent. Child meaning it's a reaction to supply and demand, or a parent, which means that it's supply or demand. So for this, we have to scroll back. We scroll back to the left until we find our price. And MT4 isn't always good at giving you lots of historical data, so sometimes I have to jump on a higher time frame just so I can find it. So there it is. Let's see if we can find it. There it is. So actually this is different, because this on a daily chart is going to constitute supply. This is supply. This is a reaction to supply. So this is the child. This is the parent. This is not supply. This is supply. I hope that's clear, because it's super important. Mike is saying, why does the nearest supply 8702 not confirmed? Is it because the move away so far has been small? Let's have a look on the hourly chart. This one here, it's because price has not, we don't have, let's have a look. We don't have 6 closed bars since this area of accumulation. So I want 1, 2, 3, 4, 5, 6 bars to have been formed for this rectangle here to be white. And I want all of these to have moved at least 4 times the size of this, which we're not even close to just yet. So it's going to show you where they are early on, but it's not going to draw them as solid rectangles until they've been qualified. So this is kind of an early warning indicator that I like to view. Okay, so back to this, you could see very clearly this is simply a reaction to supply on the daily chart, which is just here. And so we've answered the question. There's nothing in here that's interesting to sell at. This is not supply. This is a reaction to supply, which tells us that the cheapest price that we want to sell at is at the 89.42-ish area, because this is as far back as price came. And so far, price has reacted off this area at one time, but towards the bottom, you can see actually that if you look a little bit deeper, and we're going to analyze this area of accumulation because it's very important. We're going to look at this and we're going to see exactly what's going on here. When you look at an area of accumulation like this, and this is going to be bearish, my pleasure, Mike, this is going to be a bearish accumulation because we have supply. What you need to do is you need to find the bar, the green bar, or in my case, the green bar that leaves the area of accumulation. Then you find the candle before it. There are a series of questions that enable you to assess if the accumulation in this area of supply, if they're linked together, if they're related to one another. And the way I do this is to ensure that the body of this candle is in with the range of the previous candle. So this is in the range of this one is in the range of this candle, and this body is in the range of this candle, but this one is not. So the area of supply here is just here, just like that. And you can see price has not been back there yet. Price has been just back to the lows, but it has not been back to the bottom here. Sorry, to the bottom of the area of supply, which I really like. And if you want to refine your entry, you can simply go down to the smaller time frame and have a closer look. On the smaller time frame, you can see that we actually had an area of accumulation that was going on around there. So this is probably a better price that you could try and get in on. But the problem with doing this is the further your entry moves away from price, the less the likelihood that you're going to get filled, because you're trying to get a price that other people are trying to get filled at as well. And if you consider the larger institutions, they're not interested in saving 10 pips. They just want to get filled in these big orders. And so they're going to identify this area, perhaps similar to the way we do, and they're going to cascade their orders just around this area and below. And so they're going to have, if you consider a 1,000 lot order here, just at this area here, if I sold 1,000 lots just here, the order would not get filled immediately. You can't fill 1,000 lots kind of instantaneously. So what I've seen in a lot of the banks that I've worked at when I've been doing security work is that they have these algorithms that take, for example, 1,000 lot order and they slice it up into small portions. Then they'll throw these into the market one by one. And when they reach the limit of the price that they are willing to sell at, for example, if price moves down too far, and so they realize they're going to get a less than optimal fill, then they'll stop filling the order. And so this process of filling orders here looks like this, where price goes in here, we reach the area, kind of the first area of orders here, and the algos start chucking in these big orders like that. It's an amazing experience to watch, actually. And you can see this overwhelmed the buyers, boom, and then price jumped back. It found like a little bit of liquidity and stability down here. It kind of went higher. And then the algorithms, they see this and they say, if we get above this level here, we want to start selling it again. So they started to sell, and the algorithms start doing the same thing. They start slinging, let's say 10, 20 lots at a time. And this selling, constant selling, will increase the selling pressure, and this will cause price to accumulate. And accumulation, these white candles, is simply orders being filled. You can see we had one nice here. We had one day of orders being filled. Boom, price dumped. Price went higher. We started to see this where price started to move lower based on an additional filling of orders just here. you can see we haven't had that really big sharp move away yet. And so when I see this, I expect price to have another dig deeper into this area of supply, because then you know that all those unfilled orders above the highest high in this area of accumulation are still there waiting. And so now, if you consider this for a minute, you have, see if I can mark a few of these. Then we have the orders that kind of marked off like this, and they're still waiting to be filled. And so they're still there. And so the higher price if price comes above this high here, then the algo is going to start selling again until the order is filled. And so this is what causes behavior like this at key levels. And the whole purpose, this is important, the whole purpose that we wanted to, on the hourly chart, identify the origin of the move is because this is where the big selling pressure started to happen. This is where the big buying pressure started to happen. This is where the big selling pressure started to happen. Go to another chart. This is where the big selling started to happen. This is where the big buying started to happen. So it's important to know where on a price chart the big selling, the big money is buying and selling. And you can see these around areas like this, just as we've had a look at. So we go back to the daily chart. You can see that we still have these potential for unfilled orders being up at this level here. And so, looking at this, I mean, we started on our hourly chart, so we're expecting perhaps to have an entry on the hourly chart, but we were forced, due to the methodology, to move up to a daily chart in order to identify macro levels of supply and demand. This is where the smart money is selling. The dumb money, the people who are hemorrhaging money in the forex markets, the retail market, they're trying to sell in here. And so the higher you get to the top, the higher the probability of your trade working out. The closer you get to the bottom, the lower. So if you're selling here, you're going to have to be on the ball, and you're going to have to be managing your trade very aggressively. And so this is easier than this. And so I highly recommend waiting for price to come back to the major areas of supply and demand, as we've discussed here on this time frame. And so we've identified this area here like this. I mean, how do you trade that? What would you do? Well, ideally, you would. Matter of fact, I'm going to turn off the indicators, the box, so I can. So I have to do this stuff myself. Turn it off. So ideally, we've identified this area here that we like. It was well formed as well, based on the criteria. Let's have a closer look at this very quickly. So we have 4 periods. We go back to the checklist. How did price leave? So we can get these on the same. It left pretty nice. I mean, we had 2 days of bearish selling after that, and we had no wick here, so we only had selling. Here we had a smaller wick, then we had a bit of a pullback here, followed by another day of selling. How did price consume opposing demand? Let's have a look if it did. Well, the indicator would tell us this, but you can see that, I mean, the same thing. We'd be on the small time frame, we'd be looking at this. Yeah, price moved higher. What is it reacting on? Mark off the lows and scroll back. We have a look here. You can see that we're reacting on this. So, which is not a very pretty area. So we actually have an area which kind of not very well formed around here, which is tested once, twice, 3 times, 4 times. And this is what price eventually cut through. So let's look at the area that took that out. It's this one here. This area of supply took that out. And this is where we saw the reaction. So this one is the origin of this move from the major swing high to the low to the high. So this is actually the origin of the move that consumed the opposing demand down here in the bottom. So this is the one you want to target. And so yes, it did consume opposing demand. This is not a perfect area, but it did do what we wanted it to do. How long did price accumulate? Only for 4 periods, and I like to keep it under 5 or less, so that's good. And how far did price go once it left? Well, you can see the price went pretty far. I mean, price went, before it even had the opportunity to stop and turn around, it went all the way down here. So if we consider now like a risk reward for this one, I mean, it went 125 pips is the risk, and it went almost 1,000 pips. So I mean, that's pretty good. It's probably like a 9-to-1 reward risk, which is good. I don't like this. I would prefer if this was replaced with this, then I would be even more comfortable trading this here. Yes, and then you can see, has price been back there since? No, it hasn't. You can see since the release, which is this candle, this is the candle right here that left the area of accumulation, is only black space. Just to make sure we scroll scroll right, we only have black space. Now, and this is the first test. So this is the first attempt at fill orders. We got some orders, filled, boom, it drove price lower. And now we're probably going to have another go at moving deeper into this area before we find the liquidity required to drive price lower. What else do we have on our checklist here? Yeah, we won't go into details around this, but you can, I think, see pretty clearly that this is an okay area for what we've seen. This is also one of those nice patterns where price rallies. You can see we have green candles, which says that price really had a strong push. We accumulated, and we went left here. We took out the lows here. So there's a lot of interest in selling here. So this is what we're expecting when price comes back up to this level next time. And I like that price came close to it and sold off, consuming this area of demand in here. So that tells me that if price moved that far when it got to this high, imagine how far it's going to move once it manages to find the real liquidity, which is going to be above the highs of this swing. So that's what that's the whole idea behind it. And so when the indicator that I've written here, just a really good way for showing me exactly the things that I'm talking about, where I have this area which is marked off, and we have a couple of areas just up here. And you can't just take, you can trade the indicator just like so, but I don't. I use it for to show me, to tell me where the really nice moves have originated from, and then I use this quality checklist or something similar to it to help me assess if the area is high probability or not. And of course, I pay attention to the trend as well, because this really helps stack the odds in your favor, which is ultimately what you want to do. And you don't have to be right every time. As a matter of fact, I want to show you something. We're in the process of starting a fund here in Copenhagen in Denmark, and we're assessing the performance of a couple of traders. And one of the guys that we are looking at the moment, oh, sorry, let me get this back over. Oh, jeez. Okay. Okay, this guy is right 35% of the time. Would that scare you? If someone came to you and said, I want to invest your money and I want you to know that I'm right 35% of the time, would you run away with your money in your backpack, or would you give it to him? I just want to say that it doesn't matter that he's only winning 35% of the time, because some other metrics are looking pretty spot on. Average win, $13,000. Average loss, $2,700. And so he doesn't have to win every time. As a matter of fact, no one can win every time, and anyone who tells you that they're winning every time is deceiving themselves and anyone else who they're trying to get money from. You don't have to, and this is a really good example of that. And this is exactly what we want to see when recruiting traders. But also, I think that this is a really beautiful example of something that can kind of go against the mainstream thought of trading robots that are correct 99% of the time, or people who are able to trade with 99% accuracy. It's not true. And if you are right that many times, and there are other things that are going to get a little bit difficult as well. And so I just wanted to, the whole point with this is that you don't have to be right every time. And so you find the ones that have the highest probability. This has a decent probability of working out. You put on the trade and you leave it alone. You don't fiddle. And here, so if we wanted to trade this level, where would we want to get in? Well, we'd want to sell just here, which is at the bottom of the area of accumulation we looked at. The stop would go above the area of supply, and the target would go at opposing demand, which we've got something down here. This is where price touched. So this would be the second test at this area here. Now we don't know what price looks like on the approach of this area of, sorry, our entry, but we have an expectation that the price will go there up to our entry, fill the order, and then move off and down towards our target. But you don't know, of course. And so this might be an order that I'll take off depending what price looks like as it moves up towards this entry. If price rallies and accumulates, kind of like stands on a flagpole, well, then I'll take off the trade because this is opposing demand in formation, which lowers the probability of this trade working out because price is going to have to struggle to get through that opposing demand. What we want to see is a nice thin price inefficiency like this, moving up into the area, filling. There's no supply in here. You can see as well when did price stop here or here or here? I mean, it went all the way up to the source of that. So that's what we're expecting. If price goes all the way up here, nice and inefficiently, so price will be at disparity, and in order to rebalance price or return price to parity, it'll have to come back to the source of the move, just what we looked at on this move on the hourly chart, which will give us a pretty decent risk reward. So here we have maybe a 1 to 3 risk reward in this trade. So that looks pretty interesting. Ideally, we have this area down here, but we want to get out just before that, just in case we find orders below the area as we looked at on here on the daily chart. We're probably going to see those stacked up just above the order because the exact same stuff is going on here that was going on here when price moved back up there for the first time. Right. Does anyone have any questions about this stuff? Is it interesting? Do you enjoy supply and demand? Is anyone trading supply and demand today? Is it complicated at all, or it's actually pretty simple? And I think a lot of people are really try to overcomplicate trading supply and demand, but it's really a simple thing to do. I mean, the difficult bit is actually getting yourself to put on the trade. So the whole psychological bit gets in the way, of course, and so this that blurs your vision a little bit. Took a short on gold 2 days ago. Nice, excellent. It's a really great way to trade. And if you don't want to sit in front of the computer for 8 hours a day, moving to the higher time frames and trading supply and demand is certainly at least one way that can help with this. Good. Do we have any questions before we wrap things up? I've got to pick up my son from kindergarten before long, so I just want to see if we have any questions you guys want to answer before we wrap up today. So, I mean, the indicator here is that I've written is just a really nice way to show me, here we have an area of demand, but it's been tested. We had this in the child here that's been tested, so it's been turned into a dashed box. Here we have another one. This is fresh. This one is fresh. This one is fresh. If this was dotted, then I probably wouldn't take the trade, depending on how price reacted the first time it visited the area of supply. Yeah, it's really thought-provoking. And just focusing on this whole concept of liquidity it changes everything. It's a complete game changer when you understand what's going on up at these levels. And the only reason I know this is because I've been doing IT security for about 15 years. And so, I spent 99% of my time sitting inside the banks, doing security tests of trading software and hedging software and fixed protocols and stuff like that. So I got to know a lot of the developers and traders and just kind of spend a lot of time with them at lunchtime talking about trading over the past maybe 10 years or so. And liquidity distribution is an unbelievably exciting topic. And one of the banks here in Scandinavia, it's probably I think it's the 25th biggest bank in the world. I spent a couple of days, the afternoons with one of the director of their algorithmic trading, and he was responsible for the liquidity distribution. And my conversations with him during this 2-day period was probably more interesting and more enriching than all of the trading books and all of the trading courses I've ever bought or paid attention to throughout the entire one since I got started with trading, which is since 2010. It was unbelievable. So if you guys want to find a topic that will make you understand the markets better, Do you want to focus on the sell side, which is what the banks are doing? Liquidity distribution. This is unbelievably exciting, and it really it enlightens you, because then you understand what's going on at these levels. This whole thing about these big orders being sold and being thrown into the market, being filled in slices, it's so fascinating. It's absolutely fascinating. Really, really interesting topic. Good. Nice, Mike. I'm glad you like you're enjoying the material. I don't really know of any books that do this. You know what? Go find one of the investment banks in your area. I'm not sure where you live, and write to their algo and say that you're writing a report, or you want to understand it better, and see if they invite you into the bank and give you kind of an introduction to it. That's what I did. I knew the guys, of course, but I don't think that there would be any reason that they wouldn't tell you a little bit about it. You could pose as a huge investor. You want to get a little bit more information about the ongoings of the bank and how they invest money and so on and so forth. And I think that I'm sure that they'll tell you what's going on. They don't really have any literature about it, but you can also make inquiries about, for example, if you want to use an API for a bank. I know that almost all banks sell access to the FIX protocol, so like a FIX API, which is a financial instrument exchange, which is a protocol that you can use to get quotes and buy and sell different securities. Now, some of the documentation will explain that, I've seen. So that might be interesting. But otherwise, just get on the dog and bone and give them a call, or go down there and ask them for a tour. It's really insightful. Luckily in Copenhagen, we have Saxo Bank, and I know a ton of the guys there, and they're really helpful and answer my questions. And so I like to go there sometimes and spend half the day walking around speaking to people. It's really interesting. And then you really understand what's going on inside the banks, as they say, on the sell side, because these are the guys who are selling liquidity to the people like us. They're creating a market, the market makers, for us, so that we can trade. And this whole side of the market, the sell side, it's the big black box that you really need to understand if you want to get decent at trading. Super good. All right, good. Any more questions before we wrap it up for today? Okay, we've got a few more guys jumped in here. Yeah, Mike, you've been in here a few times before. I remember I've seen you in here. I think James has been here as well. Yeah, good stuff. Super. Okay. Well, Adina, if everyone is finished with their questions, I think we can wrap things up. And if you guys, you know what, I'm just going to put my email in here. And if you guys you have any questions about this, you're more than welcome to write to me. I post videos, stuff like this on occasion as well. And so I'd be pleased to hear from you and get your thoughts. Good stuff. Excellent. All right. Well, I think we'll leave it at that then. I hope you are all doing exceedingly well, and I wish you all a super day or evening, wherever you may be. And I'm going to go pick up my little boy. Okay, everybody. Thanks so much for being here, and I'll see you again next month. Thanks, FX Street.